Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from John Rubino. You can follow John over at his Substack page, and we will put a link to that down below so you can take a look at all the macroeconomic news that John dives into, but also geopolitical and also often humorous content where he's looking at the collision of logic and what we see in the media and what we see in society. So always interesting thoughts on John's Substack. And John, great to get you on the show for the first episode in 2025 here. I feel like we need to start with the elephant in the room, which is the Trump administration really shifts into power next week, about a week from today. And there's been a lot of policy ideas floated out there. Just recently, we've talked about, hey, are we going to add Canada as the 51st state? Are we going to buy Greenland? Are we going to take back the Panama Canal? But there's the tariff policies and how aggressive or not aggressive they may actually be. There's the DOGE, the Department of Government Efficiency, with Elon Musk in there slashing and cutting government spending. There's all these ideas, the tax cuts. So with the Trump administration coming in the U.S., and the U.S. being the world's largest economy, how are you parsing through the rhetoric and getting through the noise to try to find the signal?
Well, there's never going to be a dull moment for the next 6 months because they've just got so much stuff going on all at once. Now, one of the things that you need to always remember with politicians in general and new presidential administrations coming in is that it's easy to promise stuff. It's very hard to get stuff done. So the idea that Trump is going to get most of what he's been floating out there is probably a little bit over optimistic from their point of view. You know, they're going to try a lot of things, and maybe they succeed with some. And for instance, if they settle the Ukraine war and what's going on in Israel, in the Middle East right now, if they turn those things into back burner issues that aren't existentially threatening to the world, and that's enough right there. You know, if they accomplish nothing else except those two things, then Trump is Winston Churchill as far as I'm concerned, because that would be a very big deal. But they've got a lot of other stuff going on right now, some of which, well, all of which will be entertaining, and some of which might actually accomplish some good things. You know, Kennedy at the FDA is fascinating because an awful lot of what he says is absolutely fundamentally right about the public health system. You know, the food companies poison us and give us systemic chronic illnesses. The pharmaceutical companies give us super expensive drugs to treat the symptoms. And then later on, when we get cancer or whatever, and we go on chemo, which is also a huge cash cow for the pharmaceutical industry. And then that's it for us. You know, they make money off of us coming and going, and none of it is with our interests in mind. And if Kennedy comes in and addresses some of those conflicts of interest, that would be phenomenal. Lots of other places where good things might happen. So the DOGE thing, they're not going to cut $2 trillion out of U.S. government spending, but they might cut some. They might rationalize some of the inefficiencies out of some of the departments. They might close some other departments. That would all be great. So as long as we restrain our expectations to what is actually possible, this might be an interesting administration that actually accomplishes some good stuff. So let's keep that optimistic note in mind, and then, you know, come back and talk about the things that they actually do and try to do over time.
Well, it's a good point, John. I think we need to take everything with a grain of salt that's being said. A lot of ideas being floated. We'll see what actually gets done. But maybe on the not so optimistic side, we still have a very large deficit that's growing. We have a lot of initiatives in place that still need funding. We've gotten into kind of a complacent situation where the stock market's been ripping higher, and overall it seems like we've had GDP growth and good jobs numbers and inflation's coming down, but we have noticed inflation start ticking back up. We haven't seen the results this week yet. Those come out later in the week. But if inflation ticks its head up, if the Fed is forced to maybe slow their roll on the cuts, and if we see the deficit become a bigger issue, how do you think that plays out on the economic front?
Well, I think the economic front is brutally scary right now. And, you know, that plays back into what the Trump administration accomplishes, because it's possible that we have that equities bear market that's been looming out there and a big recession and everything this year. And that would suck a lot of oxygen out of the other things the Trump administration is trying to do if they have to focus on a big financial crisis in the year ahead. And, you know, it's completely possible because, yeah, inflation is rising. some economic statistics are pretty good, but most of that is because the federal government is running record high deficits. So, it's very stimulative when the government is just creating huge amounts of money and spending it, but it's not sustainable. And one of the ways you know it's not sustainable is what interest rates are doing right now. The Fed started easing in September. And since that time, the 10-year Treasury yield in the US has gone from about 3.6% to about 4.7%. In other words, the bond market is fighting the Fed. And if interest rates keep going up or even just stay where they are right now, that points towards an equities bear market, because right now the yield on the S&P 500 is like 1.2%. And if you can get 4 or 5% in a bank CD or a money market fund or any number of other short and intermediate term fixed income instruments, that looks pretty attractive in a scary world like this. So money flows out of equities into short-term, relatively safe fixed income, and that tanks the stock market. That in turn causes a recession, and there are all kinds of things going on out there that can't tolerate a recession. We're so financially fragile right now that this time around, the governments of the world will probably have to act really aggressively to stave off a recession turning into a depression. So they'll come back with bailouts and even more massive deficits. And then you get into the whole death spiral scenario. So if the Fed can cut interest rates, that will help. But it's not clear they can, because they tried and they failed. So if they come back in with QE and reverse repos and things like that in an attempt to keep the economy afloat, it could be that spikes interest rates instead of pushing interest rates down. And at that point, it's all over. So we've got some interesting scenarios out there that go beyond just garden variety, 20% drop in stocks, and then going back to normal after that. So I think the year ahead is very dicey in a lot of ways, and I think interest rates are at the epicenter of it. So you watch the 10-year Treasury yield in the U.S., and that tells you really all you need to know about where we're headed. If interest rates keep going up, we're headed for a big crisis. And so far, not just in the U.S., but all around the world, interest rates are going up. So, we're getting closer and closer to a decision point for the markets. And, I think there's a good chance that they decide in favor of fixed income and against equities very soon.
Well, John, you bring up an interesting point with the interest rates going up in an environment where the Fed was actually cutting. You would think that the rates would be going down. So it's a bit counterintuitive, but it's also caused the US dollar to skyrocket higher. It's up around 109, 110 at the time of this recording. And in a year where everybody thought it'd be plumbing down sub 100. So the fact that the dollar's up, interest rates are up, also gold is still up in that environment, which is a little unusual. And a lot of times, a lot of days in 2025 so far, we've seen gold and the dollar tracking the same direction, where a lot of times they are inversely correlated. So what do you make of the environment where dollar up, interest rates up, gold up, and it seems like a weird bedfellows to all be in the same position?
Yeah, well, there have been different forces at work here. Central banks have been buying gold pretty aggressively, so they're not really price sensitive, or they haven't been, and they've got basically unlimited money relative to the size of the gold market. So it's like they didn't care what the dollar was or anything. They just wanted to meet their gold purchase quotas. Although, gotta say, gold is down $32 in the Kitco spot market right now. So it could be that there's a kind of a bifurcation coming where interest rates keep going up, and then the things that were going up in tandem with interest rates pair off and start going back down. Equities are starting to fall now. Lately, they've been pretty weak. And if gold rolls over, that's kind of what you would expect. At a certain point, rising interest rates break a lot of other markets. And it wouldn't surprise me at all, the way interest rates are rising around the world, to see something like that happen again. And that's, it's bad in the short run for gold and the gold miners, but the sooner it causes the federal government to panic, the better it is for gold and silver, because they'll just rock in the next round of QE. So it's a question of when that happens. And that would kind of depend on how fast stocks fall. The NASDAQ is rolling over pretty hard lately, and big tech is wildly overvalued. So historically, based on valuation and what's happened in the past, It wouldn't be a surprise at all to see the NASDAQ really tank pretty soon here. And if that happened, Trump is an easy money guy. And he really doesn't have any kind of an ideological problem with governments getting involved with the market and pushing interest rates down and generating lots of growth. So he would put a lot of pressure on the Fed very quickly to ease more aggressively if stocks start to tank. So there's that. And then there's the real estate thing, or actually the real estate thing as it relates to insurance out there. The natural disasters that have happened lately are just brutalizing the homeowners insurance industry. California, where wildfires are wiping out, 10,000 houses now, some crazy number like that, and it's still burning as we're speaking. And a lot of insurance companies are just pulling out of that market. That's leaving potentially tens of thousands, maybe hundreds of thousands of houses that are uninsurable, very expensive houses that cannot have home insurance on them because nobody will sell the insurance to a homeowner in a place where there might be a fire. So uninsurable means unsellable. And what does that do to the real estate market when big chunks of high-end real estate can't be sold? And the people who own those houses are watching their stocks tank and really need to raise money. So, we've got some very complicated, intertwined scenarios out there, most of which point downward. So, the hurricanes that hit the East Coast just lately, where insurance is pulling out of those markets. Now you've got California doing the same thing. Those are high-end real estate markets, and they involve hundreds of billions, maybe trillions of dollars when you add it all up. So something like that, where you've got consumers already tapped out. So consumer spending almost mathematically has to go down for sure. You've got real estate in a very weird place where houses have never been this expensive, but huge sections of the housing market is impaired for some reason. Add it all up, and you've got a very scary scenario out there for the overall economy. And it's not clear what domino falls first, but it feels like a lot of them are falling all at the same time here, because the NASDAQ is rolling over and real estate is a mess and interest rates are going up. These are all things that point to the overall market rolling over and a recession happening. So we'll see, but it wouldn't be a surprise at all if all of these trends just continue until the economy itself breaks.
Well, John, when you think about some of these threads that you're weaving together here, the insurance issues on the housing market. I mean, I would also point to higher interest rates, meaning mortgage rates are going to go higher. That's not good for the housing market either. Consumers being more tapped out. But if there is bailouts of the insurance companies, which has echoes of the 2008 great financial crisis, if that happens, or if the Fed has to implement QE to help bail out the bond market, those all lead to more inflation. And if we have more inflation, I don't think that's what the Trump administration wants. He wants a weaker dollar. He wants a pro-business environment. But if we see inflation start creeping back up and the government bailing out sectors that are under duress, like the home market, at the same time that the Fed is bailing out the bond market, what does that mean for the commodity space? What does that mean for the U.S. equity space in an inflationary environment that maybe is going to rear its head once again?
Well, yeah. I mean, I think the short-term effects on commodities and equities would be bad of all this stuff happening, because it's recessionary and commodities are cyclical. So you could see generally in the commodity space prices going down, although not everyone goes down as much as every other. But once the Fed and the federal government together jump back into the reflationary side here, and it happens when inflation has already been sticky, and people remember what happened in 2022 when we pumped a lot of money into the system and we got double-digit inflation then, and how hard it made their lives. And people are ready to act quickly, I think, when they see those conditions recurring. So you could have, capital pour out to an extent of commodities for a little while and then pour back in a really big way, because I think it's completely possible that the conclusion that markets draw from what's happening is that governments cannot allow a recession to metastasize into another Great Depression, which might easily happen if they just stand out of the way and let market forces sort everything out. So they're going to jump back in hard with much easier money, an attempt at lowering interest rates, bigger government deficits, and regulatory changes and bailouts and things like that to go along with the easier money. And it's possible that the markets respond to that as potentially very inflationary. And so I think, maybe a V bottom in commodities and then a big bounce off that bottom. So I think 2 years from now, we're probably really happy with the price of most commodities and the trends in those spaces. It's just getting from here to there is kind of, it's impossible to predict in terms of timing or in terms of the sequence of all of this stuff. So I'd be nervous about commodities right now, but also dollar cost averaging and using lowball bids and stuff to buy the really high quality companies across the board. In other words, not just the big brand names, but the explorers and developers and junior miners, for instance, in the precious metal space, who have basically done the work already. They've found what they needed to find, they've built what they've needed to build, and they're ready to go on to the next stage. Those guys, I think, they'll get very cheap very fast in the early part of this process, and then just rocket off that bottom. So it's kind of a question of timing, then, isn't it? We definitely want to be in the high quality names in the commodity space 2 years out when commodities are rocking again. And we just have to decide how to expand into those names as all of this other stuff is playing out. And it's an interesting intellectual challenge, how to get the timing of this right.
Yeah, it's going to be interesting to see if we do get a sell everything event where equities go down, commodities go down in the face of some of those challenges, in the face of a recession or economic contraction. Could be some quality companies on sale that's a good time to bottom fish. But it's interesting. We're getting ready to get these inflation readings, and the last couple have ticked up. And when you look at what's happening in the energy sector, which is a big component to inflation, oil prices have been gradually creeping higher. We've noted that they've been range bound for some time, but they are creeping to the high end of the range again. And when you look at nat gas prices, which is what people heat their homes with, and now they're going to be building more nat gas power plants, nat gas went from 150 just 6 to 8 months ago up to over $4. And last night it was up to 4.29, and now it's back down below 4. But quite a move in nat gas as energy prices go higher. Again, that's counter to what Trump wants. He wants drill, baby, drill. And the oil and gas companies are saying, we don't care. We want to return value to shareholders through share buybacks and dividends. We have no incentive to start drilling and increasing the output. What do you make of the energy patch, John?
Well, natural gas is reacting to a really cold stretch on the East Coast. And so it bounces around depending on, home heating demand and stuff like that. And Trump's strategy of dramatically increasing energy output as a way of pushing down prices, that might be a good public policy, but it does have a potential fatal flaw in that, if you're drilling for gas, you're drilling for oil, you're expanding your refining facilities or whatever, you need to know there are going to be decent prices out there in the future. And if it's the government policy to push down the prices of what it is you're getting and selling, then maybe you're going to be even more cautious than normal about increasing your investment, right? So it could have the opposite of the intended effect. If Trump is encouraging oil companies and gas companies to go out there and produce more with the goal, the stated goal of driving down prices, So we'll have to see how that plays out. But, I think the lower energy prices was a campaign strategy. And now he needs to be talking about higher profits for the energy companies via his policies to get them on board. And that's a pretty easy rhetorical shift. But I think we kind of need to see that before you're going to see this massive increase in energy production. And that's something that in the next 6 months or so, maybe they'll change their rhetorical tone and it'll start to work. But I think that's a potential problem for them that they need to be aware of.
Well, and this isn't just a U.S. problem either, John. It's a global problem. When you look at the price of energy going up, look at how much Europe pays for nat gas and for oil. Look at how much Asia pays for it, which is why we're going to start exporting more from the U.S. and eventually from Canada. But when you look at the deficits that other countries are facing, when you look at the inflation other countries are dealing with, or the fact that they're going to have to bail out some of their industries, look at Europe. It's kind of a basket case right now. What do you make of the U.S., I guess, being the cleanest shirt in the dirty laundry bin compared to some of the global peers?
Yeah, the U.S. has a huge number of advantages right now. We're protected by big oceans on either side, and we are net, well, actually, I don't know if we're net food self-sufficient, but we are an agricultural powerhouse that exports a lot of food. We're an energy powerhouse that, like you said, is going to increase energy exports besides energy usage domestically. And that's all. Oh, and people are moving factories back here. Part of the Trump tariff strategy is not to raise money through tariffs, it's to change the behavior of a lot of manufacturers out there in the world and convince them to come here and build factories. So that's all really good. And don't forget demographics. Between Canada, Mexico, and the US, we have a pretty good demographic situation. In other words, we have enough young workers in Mexico and enough natural resources in Canada that North America as an entity is in pretty good shape. But our problem is excessive debt. We're sending government debt straight through the roof. The interest cost on that debt is going through the roof. The derivatives books of the big banks is insane. And that has to lead to a financial crisis. So, lots of things are breaking our way. And longer term, we're in pretty good shape. But that currency crisis is still out there because this debt is not you can't lower debt with the baby boomers retiring. The US has to spend a lot more on my generation for Social Security and Medicare going forward. And that was always going to lead to massively increased government spending. We just didn't prepare for it. We just kept on running deficits as boomers aged. We were supposed to run surpluses to build a lot of cash in order to get through this time without it being massively inflationary and destructive of the dollar. We didn't do it. So we have that currency/financial crisis out there no matter what. Having said that, that's not a terribly hard fix. I mean, you just do the currency reset that Jim Rickards and other people talk about, and you kind of impoverish the people who trusted the government, but you get them through that process somehow, maybe with new jobs and stuff, and then you go on in pretty good shape. So the currency/financial crisis is mostly a big deal for investors, because it's really going to send the markets into turmoil when it happens, and we have to be able to navigate that. But as far as the long-term prognosis for North America and the U.S. in particular, it's very good. If we avoid antagonizing each other here and keep our borders under control, so immigration is basically the right number instead of a massively overinflated number, then I think it's reasonable to be optimistic about the U.S. going forward. It's just that crisis that's coming that we've got to get through.
Well, John, isn't it a weird dichotomy where we would think with the massive deficit and some of these headwinds coming towards the U.S. and possibly even a recession and creeping inflation, that would not be good for the dollar, but because so many other countries are actually in worse shape financially and in the business cycle, it looks like there's money still flowing into the U.S., and when they buy U.S. assets, they convert to dollars, so the dollars remain strong. Is it weird that the dollar is so strong in the face of all this, and will it stay strong just because of the ability of the United States to outpay so many other nations?
Well, yeah, the U.S., even when we cause the problem that's in the world, whatever it is, it still leads people to send the money back to the U.S. just because even if we're at fault for whatever's happening, we're still the safest place to put money. And, the whole BRICS thing is a potential threat to that. And the coming inflation, the dollar can be strong relative to the euro and the yen and still be losing 10 or 15 or 20% of its value in a year versus real stuff. Its purchasing power can go down while its exchange rate improves. But all that means is that the other countries' currencies are in even worse shape. And that's a pretty reasonable scenario too. We had double-digit inflation in 2022. That means the dollar lost 10% of its value in 1 year. And yet the dollar stayed relatively strong compared to other currencies. And that's something that could easily continue. We could have double-digit inflation in the US, and yet the dollar index just kind of sits there or even goes up, because double-digit inflation here is disruptive for Japan and Europe and China and most of the rest of the world. So, yeah, I think the dollar exchange rate isn't the way to analyze the dollar. I think purchasing power In other words, the inflation rate. In other words, the prices of stuff you can buy with dollars. So if commodities prices are going up dramatically and the dollar is stable versus the euro, the dollar is still an incredibly weak currency because the real way of valuing it, which is its purchasing power, is plunging. So I think that's probably how things play out is, well, all the fiat currencies head towards their intrinsic value at some point over the next decade. They just head that way at varying speeds. And, I would say there's a good chance the euro just dissolves, right? So that's an instantaneous drop to zero. And then everybody goes back to Deutschmarks and lira and francs and things like that. And I think the yen, Japan's government debt is just such an outrageous thing. It can't help but force them at some point into inflating away their currency. And their demographics are pretty scary too. People call Japan a national retirement home. It's just everybody there is passing 60 and headed for 80, and they've got to be taken care of. So other countries' problems, because our demographics are not so bad in North America, other countries' problems are actually much worse in very serious ways because they just don't have the mix of young workers relative to retirees that creates a viable country. So, Germany is a mess. And, Europe, they're all making unique mistakes. We could spend a whole show just on Europe and the dumb things that they've done lately. But, you look at Great Britain, the list of stupid mistakes is very long. Germany, the list isn't that long, but it's major. It's immigration and deindustrialization and energy. They've just screwed up those things in their country to the point where it's not even clear they're a viable country going forward. So, and France, they cannot control their deficit and they can't seat a functional government. So it's not clear how France settles down to becoming a normal country again either. That's just the way things are out there. And so in every case, you look at the U.S. and you think, yeah, I think I'll buy some treasury bonds or something like that. And that supports the dollar for a while. But let interest rates spike and inflation spike here at the same time, and then that won't be good for government bonds. It won't be good for the dollar. It's just we have to measure the success of the dollar correctly.
I think that's such a key point, John, and I kind of was asking you that tongue in cheek when I asked you because it's really about the purchasing power of any currency versus inflation, more so than how it's weighted in the U.S. dollar index. It's weighted against other currencies that are all in a race to the bottom, including the dollar. So it may look strong on a dollar chart, but that doesn't mean that it's strong as far as its ability to keep purchasing what it could the year before. Look how much it's changed purchasing power, as you highlighted, just since the pandemic over the last 4 years. Prices have screamed higher and higher, and the inflation we're seeing now is on top of already high prices. So it could be that commodities actually do well, even in a strong dollar environment, and the dollar may look strong compared to other currencies, but with everything in a race to the bottom, real products, hard assets, may be going up in value. As we look to 2025, it's hard to look at a whole year, but in general, just as we wrap up here, John, what commodities are you most excited about for 2025?
Well, I think uranium is probably the most definite story out there because it's relatively immune to the business cycle. Everybody around the world is building nuclear plants, and they're going to need uranium to run those plants. So they're not going to just say, oh, uranium's too expensive, we're going to mothball this thing that we spent $8 billion in 5 years to build. No, they're going to buy the uranium that they need, even if the price goes up from here. And that's really good for the uranium miners. So those stocks they've been some of the winners in my Substack portfolio, and they've corrected a little bit lately, but that was largely because the uranium spot price went down from its $105 high. But the real price action in the uranium market is long-term contracts between miners and nuclear plants or utilities. And that's holding up pretty well and trending upward with time. So it's likely that the long-term price, in other words, what you need to pay in order to lock in a supply of uranium for the future, will stay at a really profitable level for the miners. And that means some of the junior miners will be able to bring mines online and in a profitable way, and some of the big guys will be able to generate lots of cash flow. So that ought to, by and large, be a pretty healthy commodity sector regardless. Oil is up lately, but it's cyclical, so we just don't know. Oil is also a geopolitical thing. So we don't know what's going to happen in the Middle East. We don't know what's going to happen with Russia and Ukraine, or just Russia with their exports. So oil is a harder thing to predict. But just as a general rule, we're going to continue to use oil, and the best run oil companies with the cheapest resources and the best finances should do pretty well. And some of them are good dividend payers too. Like Exxon has a pretty nice dividend on top of everything else. So oil's okay. Silver is kind of a boom bust thing because it's an industrial metal. It's a monetary metal, very thinly traded in any account. It's a small market, which means it can fall hard and it can rebound and just go to the moon. And I think eventually that's how it plays out. Gold, obviously, we're destroying these fiat currencies. So gold will fluctuate, but over time, if the fiat currencies are going to zero, gold is going to infinity when priced in these fiat currencies. Now, in my Substack newsletter, maybe 3 posts ago, there was one about Germany's hyperinflation back in the 1920s. And there's a chart in there showing the gold-backed mark, which was a version of the German currency that you could actually convert into gold, priced in terms of the paper mark. And it just went straight up. It went from a reasonable number up into a number with massive numbers of zeros at the end of it. And that's kind of what gold will probably end up doing versus the fiat currencies out there. It'll go to just stupid, incomprehensible numbers, but not because gold did anything remarkable. It's just that these currencies, once they fall into their death spirals, are going to just fall very fast. And the commodities priced in them will go up equally fast. And gold is going to be one of the big beneficiaries from that.
Well, John, I think we'll wrap it up there, but I appreciate you going around the horn on a number of different commodities there as far as your outlook for the year to come, looking at the macroeconomic forces we have in the background, the geopolitical forces, all the different administration changes, not just here in the U.S., but in Europe and Japan, and looking at what's happening globally on the global stage as far as trade and as far as how this all ties into the market. So definitely a lot to think about and process as we kick off the year here. And if people want to follow along with John's work, definitely click on the link below this interview. It takes you right over to his Substack page where you can follow along with his daily missives, and he provides a lot of value to subscribers as far as what he's doing in his own portfolio of resource stocks and even other stocks that have his attention outside of the resource space, both on the long side and on the short side. So a lot of information at John's Substack page. John, it's great to have you on the show as always, and looking forward to our next conversation.
Thanks, Shad. Talk to you soon.